Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for February 22nd, 2014. The market has calmed down to bullish normal conditions. On an annual basis with weekly RSI 14, we're at 66 out of 100, the high end of neutral. On a 10-day basis using the 10-day NDX, we are overbought at 89 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is 7.43% or yellow bullish. About 5.5% cushion between current price and the sideways market. Slope of the 50-day moving average improved to yellow neutral at 0.25%. ADX has diminished in terms of strength of trend down to 18.3 or a neutral trend using ADX 14. Relative volatility measured by ATR percentage compared to the last 100 days is back into normal at 1.06%. The VIX risk index, which is the 30-period moving average of the VIX divided by the 10, comes in with a score of 1.05, which puts us into risk on conditions, meaning that riskier assets are now favored. Anytime that's over 1.0, it's risk on. If we take that score of 1.05 and compare it to the scores of the last 5,000 days and normalize that with standard deviation, we have the risk z-score then, which comes in at 0.52. This is the 90-day time series of that risk z-score. You can see that it has rebounded from a reading of minus 2.5 standard deviations up to positive 0.5. This has been a very good swing trade in XIV and is now back above the zero line in terms of standard deviation, so we are into risk on conditions. No change in blended monthly rebalancing. You can see the holdings that we started the month with, and then the current readings of the database based on these different portfolio populations. You can see the top three for ETF 13. It's all US with tech, small caps, and mid caps. With ETF 22, it's healthcare, tech, and healthcare, tech, and European 350. See the leaders among the Dow 30, the top 10 among the ETF 200. There's a lot of natural gas and biotech reflected in here. ETF 2, the theoretical exposure is at 70%, and the model portfolio is at 100% exposed. This is just a quick look at the ETF 13 and 33 portfolios under current readings. We're back up to about 3/4 of the portfolio there being on buy position with price better than the 88-day or the 4-month moving average, with only Japan, emerging markets, and Latin America on a cash position. And again, you can see the difference between the 3-month performance in Latin America at minus 11.5 and U.S. tech at 7.5. Then the top 33 or the top 50, among the ETF Max population. Global carbon, natural gas, coffee, more natural gas, more coffee. Here's the biotech XBI and IBB and BBH, both of which are biotechs. You can see how that and medical services and healthcare are dominating the top 50. The solar ETF, you notice that's white and then green. That's been cooling off relative to the other leaders. So we like to see our greens or green and white. So the energy ETN here, JJE, is actually one that is earlier in its life cycle of outperformance, if you will, because that's green and white. So it's an emerging leader in strength, as would be the GSTI networking at green and white. Whereas if we saw Greece and clean energy, again with white and green, you can see that they're slowing down their recent performance compared to the those in the that are greens across the board. Now, what's interesting here is the shift into precious metals. You see the gold explorers GLDX green and red, and the same with the silver miners green and red. That's a sign of even more recent performance, outperformance, if you will, short-term momentum in the precious metals. Market health check. Vertical blue lines are 10, 20, and 30 days worth of look back. The dark blue shaded area in the middle is the 30 period Bollinger Band, the river, plus or minus 1 SD. The lighter blue shaded area is the floodplain, that's the 30 period Bollinger Band, plus or minus 2. The pink shaded area is the dragon, that's a 10 period Bollinger Band, plus or minus a half. That just confirmed this recent turnaround where the dragon came all the way out of the river and has reversed and has now come all the way back almost to the far side of the river up here in the north, providing support all along the way. We've got 3 regression line channels in here. Then blue is the short term, it's a 10-day, very steeply up. The 30 period is lagged by a day as the black line. You can see the slope value of that reflected in this sine wave looking indicator. That's the slope of the 30 period regression line. It is almost back up to the 0 line here, which is this dashed line. And when the last 30 days get to flat, you'll see that that slope line goes to flat. And then when that's trending positively, that's been a very good sign. So this gave us an indication of the steepness of that adverse move. And when it turns, that was part of confirmation of a bounce off the sell-off. That bounce, you can see, got all the way out to minus 3 standard deviations. That's the Z trade score. And then the long-term regression channel is this green line here. The long-term trend remains intact. So we have price in the upper half of the 30. It's right on track back with the previous 90-day channel. And the 10 is steeply up, although those 2 selling days have caused it to not get quite so steep. So that's cooling off after this kind of extraordinary looking move. We have a price target here at 185. That's the beginning of the green zone for me. Excuse me. With a soccer tournament this weekend, I was outside in the cold quite a bit. Anyway, when price is up here in the green zone, that's my area where I'm going to adopt a longer term bullish bias. I want to be long and strong anything when price in the market is above that purple line. The yellow zone is the area in which I'm generally bullish because of the long-term trend, but that I'm willing to go in either direction intraday based on the primary move of the market that day. And I will let that become more important in my decision making. And then the red zone would pick up around 177, which is an important support level, which if violated would open the door to some downside moves. You can see the jaws of percent price oscillator have opened to the upside. That's favorable. We've been overbought for 12 days. We can stay that way a long time. Although we've seen a couple days finally of some pullbacks here after this extraordinary bounce. And then finally, ADX you can see is pulled back below 20. It's almost a toss-up between bulls and bears. But that's going to quickly shift into favor of the bulls once we drop off this last big selling day here and are concentrating just on this move. So this is a market that has recovered from that 5% sell-off nicely, getting ready to test all-time highs again. It won't take much more follow-through to get me into the long-term upward bias once more. But this would also be a natural place to see some hesitation and resistance. After all, it held off for 20 days back here just before this sell-off. So let's see what happens on this test of the key 185 price level. ETF2 regional report. We've got 3 out of the 10 regions are on cash, 7 on a buy. That puts us at a theoretical allocation of 70-30 in terms of market health, which has improved by 10% from last week's 60-40. The S&P at 47 is better than the globals, which are at 46. But you'll notice that Europe is getting stronger than the U.S. with a score of 49 versus 47. Inside the U.S., it's technology at 52, then smalls at 48, mids at 48, and then the large caps are lagging now at 47. Two strongest sectors are technology and Europe, and the two weakest sectors remain Latin America and Japan. None of the U.S. sector spiders are exceptionally above average. Still strength coming in the healthcare XLV. World market model, the Dow is lagging. The NASDAQ is very strong. Otherwise, the U.S. is above average. Asia less Japan, all below average. China and Vietnam, the only two real bright spots exceptionally above average in Asia. Everything Europe is above average. Spain exceptionally so. And even in these broader indexes in Europe, you can see are all above average. Latin American emerging markets are lagging. Brazil and Mexico especially so. It's interesting to note that gold and silver have gotten out of the red, and silver is actually above average right now. It's been that stealthy shift to the precious metals, and it'll be interesting to see if that continues, especially if there's any hesitation in the U.S. after this nice little bounce. Could be time for the silver. We've been stalking silver Wheaton on a very nice swing trade exactly for that reason. Business sectors are about a toss-up between U.S. and their global counterparts, with maybe a slight hat tip going to the U.S. still across the board in a couple areas of tie, but it's a slight hat tip to the U.S. ETF top 30 using the ETF2 point of view. You can see the emerging strength in silver, green and yellow, and gold miner juniors, green and yellow. Semiconductors and home construction, green and white. So those are going to be the ones that are emerging strength. There's S&P 500 growth. Alpha Dex, healthcare, clean energy, still green and white. So still a few to choose from. Long-term strongest being green and green, such as natural gas, biotech, are still dominating the top slots here. Looking at the Dow through the same lens, key winners: Disney, Caterpillar, Merck, Visa, American Express. The losers in the red and then yellow. That's relatively recent losers. So they've been below average longer term consistency, and now red, so they're getting worse. GE, Travelers, AT&T, Walmart, Procter & Gamble, Coke, and Chevron. Boeing used to be at the top of the stack, but has now drifted back into yellow. So there may be a value play available in there. Looking at the ETF liquidity, those that are in green are exceptionally volatile relative to their peer group here. Whites are above average, yellow slightly below average, red extremely non-volatile. And these are the top 30 based on average daily dollar volume of the last 30 days, just to give you a sense of what kind of intraday travel and you can be looking at for intraday trading with ETFs. Just interesting to know just how much more volume there is now in the small caps than there is in tech on a relative basis. Looking at the daily report now for February 22nd. No signals in channeling or overreaction. None of the patterns have fired in the swing systems. On the auto framer, VIX, Walmart, Coke, and Visa all test out better than 2 to 1. You can see the 10-day max pain candidates. These are the ones that have lost the most on a percent basis from their 10-day high, and the 10-day min pains are the ones that are closest to their 10-day high. That's, I think of those as market leaders and laggards. See that the volatility spike is over and is pulled back into normal. That has corresponded with a very good swing trade in XIV. So there's the possibility of trading on that information that we use for market classification as well. It's more than just the information, it can also be traded. Top 5 in the Dow on max pain range compression. Coke and Walmart are going to be worth looking at because they also test out well on the auto framer, and then especially Walmart, which closed in a doji on Friday. Walmart and General Electric both signaling on the RSI2, so Walmart is one that should be of great interest. Has an RSI2 value, was not a big loser on Friday, and so maybe the turnaround's already coming, and has a 3.5 to 1 reward to risk ratio, so Walmart will pay some attention to that. On the extreme positive side, look at Disney, which has been an exceptional winner in terms of percentage gains over any time period you want to look at between 1 day and 12 months, and closed at all-time new highs, or look back period new highs, made a new 10-day, 1 month, 3 month, and 6 month high on Friday, as did Merck. Inside the ETFs, none of them registered in the single digits on RSI2. Only the VIX tests out on the auto framer, not surprising, and then a handful of dojis as well. These are the auto framer mechanical frames for the VIX for Walmart, which we talked about, Coke, and Verizon. And the last chart we'll look at, the market mosaic. You can see the market has made that recovery. The polynomial regression line is still pointing steeply up, although it has cooled off a little bit in the last couple, 3 days. The 30-period regression line is almost back to flat or positive, and when it does, you'll see it cross this dotted red line on this time series. But it crossed its own 10-period moving average at a distance more than 1 standard deviation from the 6-month norm. Here's where that occurred. And so this move up right here from 181 was the place where you would expect it to fail if it wasn't going to follow through, but because it took off after this little doji, that has propelled it all the way back up to retest 185. So we'll see where we are. This is the 6-month look at that same indicator, and we're right back to the 6-month average, and we made an almost 2.5 standard deviation move off after this sell-off, as measured by percent relative to the 200-day moving average. So it's looking like the market is back to fair value. So that's the executive summary of our reports. Each of the report pages goes deeper, but we won't be commenting on that tonight in the webinar. So take good care. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.